Hello and welcome to LiveSquawk's Market Talk Preview Show on Thursday, 19th of March 2026. Today's episode previews the impending Bank of England and the European Central Bank interest rate decisions that come later today. In the case of the Bank of England, the announcement is scheduled for midday GMT. For the ECB, it will be announced at 13:15 GMT, with the presser set for 13:45 GMT. To help me break down the expectations for both central banks, I'll be joined by Eric Culp, LiveSquawk's European editor, and Jamie Dutta, market analyst at PIQ. Before I bring you both in, just a quick disclaimer. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. That's over and done with now, and we want to press on then because again, it's quite a busy, it's been quite a busy week actually for central bank activity. With the RBA, we've had the Bank of Canada, FOMC yesterday evening, and today we've already had the S&B, the Swiss National Bank, and we'll have the Bank of England, as I said, ECB later today as well. And we've also had Bank of Japan as well. So again, it's been a bumper week for central bank activity. We'll focus now on the Bank of England. There is a preview up on the LiveSquawk website. BOE set to hold rates as geopolitical risks intensify. Bank rates seen on hold then amid heightened uncertainty. NBC expected to vote 7-2 to keep policy unchanged. The energy shock models inflation outlook with markets push back rate cut bets. A day ahead of the BOE and the ECB rate decisions, both North American central banks, as I mentioned, opted to leave policy unchanged. Bank of Canada's Tiff Macklem said it was too early to assess the economic impact of the conflict, though he warned it would likely lift global inflation in the near term. A similar message was echoed by Fed Chair Jerome Powell later in the day. Sanjay Raja of Deutsche Bank said he anticipates a dovish wait-and-see stance. The embassy won't be rushed into rate cuts on the 19th. Geopolitical events have clouded the economic outlook, barring an imminent resolution to the Iran shock. The effects on the economy will be meaningful, with GDP lower, unemployment higher, and inflation pushing well above the Bank of England's February projections. So on that note, then, Jamie, I want to bring you in first. Then we're probably going to get the similar sort of message as I mentioned there. Do you see, where are the nuances in today's Bank of England statement, do you think?
Yeah, hi, Harry. The nuance is a very good point, because otherwise we could just talk about everyone sitting tight and waiting and seeing, a bit like Powell did yesterday. Of course, I don't know how many times he mentioned wait and see to most questions in the conference afterwards, but I think he sort of chuckled to himself.
About 15 times.
15. Oh, right. Okay. I think there were 18 central bank meetings this week as well, by the way. So, it's double figures for quite a few of these things. I think they are in a different position if we compare them to the ECB, I guess. They are in, rates are currently sort of mildly restrictive at the moment anyway, compared to, say, the ECB, as I say. So they can probably afford, that gives them a bit of a license to be, a bit more patient and passive in a way. And then we've had that labour market data today, pretty much as expected, I think. But there's clear that there's labour market slack. And then along with a pretty sluggish growth environment, right, with I think it was 0%, wasn't it, GDP in January, for example, then, they can hold off on things and potentially look through. Well, I'll use that phrase probably for the ECB more than the Bank of England in a way, but look through, ECB, different, but yeah, Bank of England will look through moment, and of course, then it's is it the lap of the gold, or is it up to Trump to see how long that everything how long go on for, and whether a period, and then whether that then feeds through, which I think the UK is more important that we see wages and pay settlements.
Sure.
And that pass through there rather than sort of inflation expectations for households and that type of thing. So those are I think, if that makes sense, some of the nuances for me in what we get at 12 o'clock. And the vote, as you say, could be interesting, 7-2 or 8-1. Is that going to matter that much at the moment? I think Powell, very briefly said, about the bottom projections. He said if we could have skipped it, we would have, which kind of sums up as well. ECB have got their staff projections, haven't they? I think Bank of England don't, but yeah, there's a couple of nuances there, I think.
Well, I think in terms of the vote, in terms of reaction function, it may well be that's what traders, take a jump on initially, because as you say, it is the nuance in essence there. It's a wait and see. I mean, I think we were, like you said, we're pretty much set for a cut today. We're still, I think, the pricing is still 2 cuts for this year, but a number of bank research there to push that them back to, I think, if I'm right, I think September time now, September and a bit later as well.
I think JP Morgan have pushed back to 0 this year, right? I think that was yesterday or the day before.
Yeah,
and I think there's about 36 basis points, I think, the last time I looked, for this year for the Bank of England, which is a lot, I would say.
Yeah. So I'm all right. I've fixed my mortgage, so I managed to fix my mortgage at the start of the year. So there we are.
But
well
done. Yeah.
It was smug, but there we are. Right, I don't want to labour too much on this, because I do think because we don't have a press conference today, we will be getting Bailey, the governor, Bailey, just appearing on nationwide news, doing the circuits at the moment with journalists. So we will get a bit more of an explanation and a bit more understanding, I think, from him about the bank's view. But I really don't see it, and I think the market feels that way, that it's going to be very similar message to what we've seen in these uncertain times. Like you said, and you pointed out, it's a wait and see approach for the Bank of England. And when we'll look at the connotations around the inflation picture, and is it really something that will mean we're more likely to see hikes than cuts, or the damage it may do to economic activity is the more underlying factor here, as I discussed yesterday with my guest regarding the FOMC and the US economy. Potentially we could see a higher rate of accommodation coming back into monetary policy. Just a quick note from HSBC here, and then we'll go on to the ECB. So the HSBC said at one point before the outbreak of conflict in the Middle East, the market was pricing in circa 85% probability of a 25 basis point cut at this meeting. With the rises in energy prices since then, though, that is now completely off the table. We still think the committee's Doves, Alan Taylor and Swati Dhingra will vote for a cut, making it 7-2. But for the rest of the committee, a lengthy pause will probably now be seen as the base case while we wait to see how global events play out. We have not really heard from any of its members since the conflict has taken hold. Alan Taylor spoke in the early stages, but still sounding somewhat dovish, but things have escalated since then. So this will be the first opportunity to see how the committee is reading recent developments. And the bank suspects that there will be a split down existing fault lines, with some more worried about second round effects on inflation, and others more worried about the demand side, as we've discussed. The committee will have early sight of the labour market data, which will be released on the morning of the announcement. But this may no longer be the first order as it was previously. In other words, even a really weak jobs and wage picture might no longer feel as dovish given the new energy pressures. So that was commentary there from HSBC. So we did get labour data out this morning. Eric, I want to bring you in now for the ECB. Now,
hi guys.
Hi, Eric. Sorry, we're on manners. Same applies here, really. ECB set to hold rates again as fog of war clouds outlook. This is your preview piece that's up on the LiveSquawk website. Inflation ticks higher. New forecasts may already be old. So what scenario, you asked the question there. Do you want to give us a little bit of a preview of what you expect from today's decision?
I think the ECB is going to do pretty much what almost everyone else has done and do nothing. They're going to come out and say, well, the situation is changing constantly. Because Lagarde likes to talk, I expect a number of scenarios that they'll talk about. I don't think they could really put in the information. They don't have enough information about what's going to happen to prices and growth due to the war, because we don't know what's going to happen with the war. So they'll have their baseline, which will probably be based on what they've done over the past 2 months to do the latest forecasts. And then she'll probably talk, well, it could be this, it could be that, and we're going to monitor. I don't know if they're still in the good place, though.
So that good place was set to keep us on hold for the year, with, like you say, the potential for, well, some had priced in the potential for hiking. I've got an
Right.
HSBC.
If I can add something
Go
too,
on.
what I've noticed is that the traders, the ones who actually have money in the market, or at least playing with other people's money, they've now see 2 hikes by the end of the year, and 60 basis points. That's a lot, right?
Yeah.
And at the
Yeah.
same time, the economists don't see diddly. Of
Yeah.
course, they don't lose their jobs if they're wrong. I guess we're going to have to go with the traders. I also think they're a little bit more worst case scenario, which the scenario right now, it depends on what kind of mood the people in Washington are in. It changes all the time, but they're dogging the Israelis about smoking some Iranian oil fields. I think midterm 6 weeks is the number I'm hearing on the war.
Well, I
Six
think
weeks in total, or 6 weeks from here?
Probably in total. I think that's what a lot of
Okay.
people are talking right now. But the problem with these scenarios is here's a dartboard and go ahead and throw.
Yeah. But then we're halfway through that, then, right? Over halfway through, if it's 6 weeks total, right?
Yeah,
Pretty much.
Yeah,
we're in the
that,
third
yeah.
week. We're in the third week now of
exactly.
of the conflict.
Yeah.
And we've got the known unknowns and the unknown unknowns that come from this. And what we have seen is, this bombing of infrastructure that we've seen, and you're referring to the Israelis bombing South Pars and Kaj Island. We've seen the retaliatory strikes on Qatar's the name
LNG, right? Yeah,
LNG
facilities.
Plant
There we go.
And on Saudi oil refinery.
Yes, this is going to the repair time for all this as well. So there's going to be a bit of a bottleneck, even if this were to finish in another 3 weeks. Hopefully sooner. But this is the ramifications for this. The sort of shockwaves will continue, I suspect, for months to come. And so even if the war itself, the conflict does finish, and I'd like to think it would, but who knows is the short answer. Not even the US president knows, really. We are going to be feeling this for the rest of this year, at least, I think, and from what I've read and what I've understood. So how do central banks, what are they looking for in terms of tells? I mean, Jamie, all I've heard is expectations. It's about inflation expectations being anchored, because that's what the central banks will feed off of ultimately. Do you agree with that? Do you think that's where we should be looking in terms of tell signs about,
Yeah, I think Eric put it well with the 54, 55 basis points, right? That's what we look at, or that's what I look at. And then, so is that too much? Is Lagarde going to keep pace with that hawkish repricing, right? So is she going to offer that guidance for markets that is 55 basis points worth? And I think if you look sort of before, and when I said about looking through, generally, I wrote initially about this whole thing saying, they're going to look through, it's going to be an energy spike, price spike, and that will be it. But then they do have, and I know Schnabel talked about scarring, scars from the previous wars and that kind of thing. Their last wars, against inflation, so they were too hawkish in '08. They were too dovish in 2022. So then do the hawks, overcome the doves with this sort of we can't let this happen again type thing, or are the doves going, no, we're not going to refight any of that last battle, and we can be patient. I think if it's 6 weeks and we're sort of nearly halfway through, then they're gonna look through. They're going to be scarred, but look through it in some way. And again, the ECB slightly different place, right, with rates, because they brought rates back to neutral pretty much, 2%. So does that make it harder for them in a way to stand pat, sit on their hands, compared to, say, the Bank of England? And then even then, if they did go, they're up to 2.25. Is that restrictive enough? That's still sort of top end of the neutral range. I think, 1.75 to 2.25 is the ECB sort of estimate. So, obviously it depends on how long the war goes and how long prices stay up here, I guess, if that makes any sense. But it's slightly different place and more scarred in a way, I think. As I said, Schnabel, I heard it from her saying about that, and that's different to, I think, other policymakers for me.
Well, there is also this again, part of these second round effects. Again, we saw German industrial production, I think, dropped output. We got output dropped by 0.5% on the month. Orders fell through the floor.
Yeah, that's correct. The numbers were much, much worse than everybody expected.
And then obviously that had a knock-on effect. I don't know if they would have seen those when they did the survey, but for the ZEW, for example, and we saw expectations there also created, didn't they, Eric, this week?
They sure did. I mean, they went negative, which no one expected, from 50 plus. I think it was almost 60 to a negative 0.5. Huge drop. I think it's the worst since last year when Trump rolled out those tariffs.
Almost seems self-inflicted, doesn't it? All of this. So in terms of activity and economic activity, is it a bit preemptive to be looking at trying to hike rates in an environment where, potentially we've got stagflationary pulls and pushes at the moment going through? So again, where does the central bank go in that scenario?
Well, I think, ABN AMRO, they made a point that if this gets worse, we could see a hike next month. And I'm thinking, yeah, maybe. The problem, I think, right now is Germany. It's hard to say if the rebound's going to take hold. A lot of money is being spent on weapons, which understandable considering the current environment. There's some concerns that not enough's being spent on domestic infrastructure, but I think that'll come around.
Well, I mean, we got updated projections, as mentioned in your preview, and Barclays here say they're likely to show weaker near-term growth with risks to activity skewed to the downside. They said headline inflation should be revised higher on the back of higher energy prices, with a balance of risk to inflation assessed to be on the upside. As in past episodes of major geopolitical shocks, we expect staff to present an alternative scenario in which broader and more persistent energy disruption has a more material impact on the outlook. Again, looking, how much do you think they might look through this near term? Like you said, there's a possibility we could look at a hike next month, but will they not want to look at a couple of months worth of data before they decide to pull the trigger in one direction or the other?
I think that's a smart call. I think everything you just talked about makes complete sense. I also think that maybe the analysts at ABN AMRO are just covering their tail ends, right? Saying, yeah, this could happen. I think you have to the market's very fluid right now. Let's face it. We don't know what the next headline is going to be. It's weird to say the markets have also become resistant to a lot of, I see a headline that maybe 5 years ago would drive a market.
Yeah.
And now I see it and the market's like, oh, I'm going to yawn now. And we're going to continue on. So,
kind of scary.
Yeah, it is. We talked about this before the show also, that we're kind of accepting more and more crazy in the world. And so, because the crazy sounds crazy, but when it actually happens, it's more meh than anything. You're like, who cares? And I think I think you're right that next month is probably a little early unless some crazy stuff happens. The problem is Brent. I mean, if you look at oil prices right now,
Yeah.
Brent is what it's above 110, right? This morning. So
Mm.
if it stays there, there's a lot of scenarios for where WTI and Brent are, and how that's going to affect the inflation in general, and it's gonna hit growth too.
Yeah.
I think it's interesting on that, definitely with that, Brent overshoot in a way, but it's this overshoot undershoot as well for me. So where in Europe we had the undershoot, obviously with inflation, then what we go to 2.25%, 2.5%. Is that too much of an overshoot for them to react? Probably is, right?
Mm.
2.5%, but we're not talking. And I liked
So you there?
that back, didn't he? And said
Oh,
we're
sorry,
not in
Jamie.
the
You have to repeat the
70s.
last 10
Let's be
seconds.
honest.
Jamie, you have to
Yes.
repeat the last 10 seconds of what you said, 'cause we didn't hear it.
No, I agree with Eric, and just pump prices obviously then potentially having an effect. But what I wanted to say was just about whether inflation at 2.5%, is that a big enough overshoot where we've had this undershoot for the last few months, of course, with HICP, but then 2.5%, is that a big enough overshoot for them to react? And you've just mentioned stagflation, and I think we go back to Powell yesterday and his sort of swatting away of any mention of stagflation, because that's a 1970s term, which was completely different, the numbers that we were talking
Yeah.
about compared to now. I guess it's relative, but still, a shock of that magnitude, and that is crazy, as we just been talking about, and we're not used to that. But 2.5%, is an overshoot big enough to react?
Well, you
Yeah,
get into that T word, transitory, or as I like to call it, persistence. And
yes.
I think for all I've read and heard from, again, we've had a number of central banks now, Australia aside and the RBA aside, they're looking for more. They want more information, more feedback, really, more anecdotal evidence before they're willing to move from their current policy stance. And I think we could be in for a barren spell of, personally, I think we're in, and from what I've read, we could be in for a barren spell in terms of central bank action here. A lot of words and very little action in the near term, until there's just a better handle on where we are with this conflict and just the full ramification. So that's what I'm reading, that's what I'm seeing. But markets are likely to react nonetheless, and to make those knee-jerk moves in the near term before settling down and maybe doing the same. Like you say, we're becoming inured to the is that the word? Inured,
Yes.
Eric,
Yeah.
the wordsmith.
That's solid word.
Awesome. To these constant
one quick
shock.
thing there, Harry, is I did write down literally the T word.
Oh, you did?
Yes, as a point, and they can't dare say that word, can they? I guess. Can they?
Well,
Eric, do you think?
I'm not sure I know what T word you're talking about.
yes,
Transitory, right?
Yeah, I mean, does that mean anything anymore? I don't know. It's
It was damning. It was damning, wasn't it, back then?
Yeah, if it did mean anything, they've absolutely ruined it.
Yes, that's what just to be
put it that
clear,
way.
right?
because they ruin everything.
They do. Right. Okay. Well, I guess just to wrap up this episode now, because we are moving closer towards the Bank of England itself. As I said, it's really all about the communication on both sides of the channel, really, to understand where the central banks are. But the general feeling is that we're in a holding pattern in the short term until there's a clearer path to see. So if you want to find the previews, you can find them on our LiveSquawk.com website. So the Bank of England in decision is coming up in about 90 minutes from the end of this recording here. So at midday London time. And we're looking for rates to stay on hold. They're at 3.75% with a vote of 7-2. And then the ECB is a couple of hours later, and that's due at 13:15 GMT, 14:15 Central European time, with a press conference half hour after that at 13:45 GMT. So yeah, read up on all that. And listen, I'd like to thank my two guests. Thank you, Eric.
Good to be here and had fun as always.
You and Jamie from PIQ. Thank you very much.
Thank you, Harry. Always a pleasure.
Excellent. Anyone who missed the start of this can go back on our social media platforms and pick up from the start, or to podcast platform, Spotify and Apple iTunes, if you want to hear it in its entirety. So, but thank you everyone for listening, and we'll see you again tomorrow for the weekly wrap.